Hi, my name is Charlie Moran. I'm a senior analyst here at Value Line. I'm joined today by two other senior analysts, Sharif Abdu and Alan House. Today we're going to provide an update on the economy and stock market. We will also discuss the actions Value Line taking to help our subscribers navigate this still challenging time. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make make informed decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. The service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now, let's discuss the economy and the stock market. The content that I'm about to read was prepared by Value Line's economic staff prior to yesterday's FOMC decision. With that, let's get to this. The inflation picture remains problematic. The August reading on consumer prices came in stronger than expected, with the core consumer price index CPI figure, which excludes the volatile food and energy components, rising 0.6% on a month-to-month basis. That was double the consensus forecast. For the 12-month period, the CPI and core CPI rose 8.3% and 6.3% respectively, with both advances topping expectations. All the broad market indices recorded their worst single-day losses since the first year of the COVID pandemic in 2020. Investors anticipate that the Fed still has a lot more work to do in its fight to tame inflation. Several central bank leaders, including Chairman Jerome Powell, struck hawkish tones on monetary policy leading into this month's FOMC meeting that occurred yesterday. The expectations for additional rate increases into 2023 also rose in the wake of the latest consumer pricing data. The U.S. economy is hanging in, but with the Fed aggressively tightening the monetary reins, it may not hold on for long. Both manufacturing and non-manufacturing services activity expanded for the 27th consecutive month in August, and recent jobs growth remained solid. However, with the central bank notably decreasing the money supply via rate hikes and balance sheet reductions, further demand destruction seems likely. On point, the housing and home building markets were under significant pressure this summer, with higher mortgage rates raising affordability concerns and leading to a sharp drop in demand for homes. At least a mild recession is beginning to seem inevitable. The continued inversion of the Treasury market yield curve suggests such, and the slowing profit growth in corporate America may be another sign. The consensus third quarter earnings growth estimate for the S&P 500 companies is less than 4%. This would mark the lowest rate since September 2020, when the coronavirus pandemic was raging. According to FactSet Research, nearly half of the S&P 500 companies used the term recession during their earnings calls, which was well above the 5-year average of 52 companies. In conclusion, the slowing growth environment and continued inflation concerns have made for an unstable investment landscape. With this backdrop likely to persist for some time, a cautious investment stance is recommended. Overall, we believe that stocks should continue to be a part of a well-diversified portfolio, though some caution is currently warranted. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's at www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard where I am already located. This is the main landing page for subscribers. Under the quick links, you can click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last 2 years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock's safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong. Over broad index funds, certainly certainly particular industries and sectors will recover more quickly than others during and after the pandemic runs its course. Now for an intro into the screener and our one stock to buy right now. Let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-Value Line. So let's go to the screening criteria and the steps. Since market conditions are fluid, especially now, and long-term visibility remains clouded, we're going to focus on equities with superior prospects in the short and intermediate terms. Today, we'll start the screening process by looking at ranks and ratings in the ranks and ratings section. Thank you. There we go. The first filter that we're going to look at here is a financial strength rating of at least A+. So we'll scroll down to the financial strength section of our screening criteria, and the first screen we're applying is financial strength. We are looking for stocks that carry a rank of A+ or A++. The scale goes down to C+ in 9 increments. There are roughly 5,600 stocks in our database. By applying that one screen, we're already down to, I think, 149 stocks, which was the case this morning. We've substantially narrowed down the list of candidates. We want to concentrate on the theme of near-term prospects, so we're going to apply another filter, and this time that filter is the 18-month total return midpoint of at least 40%. Going to the company data section, the next screen is at least 40%, while Timeliness ranked for the 6 to 12-month investment horizon. We believe it's a good idea to look at the intermediate time frame, and by applying this screen, we've narrowed our list of candidates down to 45 stocks. And now we'll return our attention to market cap. We wanted to have some liquidity given the turbulence in the market, and we wanted to have a market cap minimum of over $10 billion. This reduces it to 43. The next filter is a PE ratio of less than 17. That is in the valuation heading, and we're choosing the filter there. It seems to be loading. The stock market is currently trading at about a 17 multiple within the value line universe of stocks. And remember, the PE uses the earnings from 6 months forward and 6 months backwards to obtain the per share earnings total. This sum is divided into the current stock price. And this whittles the prospect list down to 18, I think. And then the final filter is safety rank of 1. Our last filter is a measure of risk. As mentioned before, the safety ranks are between 1 to 5, with 1 being the highest. These stocks offer our highest measure of safety, but also allow for upside appreciation in difficult markets. And when you apply the 1 safety rank, let's see, we're loading here. Well, it's 16. And that provides the list of available stocks. I think that the filters are a little bit out of place here, because the stock that we had, you want to minimize the PE ratio, have a 17 top. You go to the filter, it should be a 17 top. There we go. Sorry about that. I was reading the content. And there we have our 10 stocks. You can make a strong argument for any of the 10 remaining candidates, and investors interested in adding new positions should consider them. However, only one stock can be today's one stock to buy. And right now, after consulting with a number of my senior analysts, we prefer and recommend Medtronic. Before I click on Medtronic, please note that screens can be saved and revisited by utilizing Create Save Screen button at the top. As far as Medtronic, the company is one of the premier global medical device makers with a strong franchise and solid history of growth during all types of economic cycles. With nearly 100,000 employees, it sells its products into 120 countries, and international sales represent about half of its total. It derives most of its sales from devices used to treat cardiac and vascular diseases, approximately a third, and the remaining 2/3 of sales target diabetic, neuromodulation, spinal, and a slew of other categories. Its sales eclipsed $31 billion last year, and we look for decent earnings growth this year thanks to renewed interest in elective surgery procedures following the COVID-19 pandemic. This business will be complemented by tighter cost controls, permitting some modest margin expansion, One concern and one caveat that we have is the strength of the dollar, which caused a $75 million adverse foreign exchange loss in the final quarter that ended in April. Management has a long track record of partnering with other companies to extend the usefulness of its device technology into other areas, and we suspect that this engine for growth will renew in fiscal 2022. New innovations within its core markets, spinal and cardiac treatments, should also boost results. We view the recent setback in the stock price as an opportunity to buy a high-quality company for a decent valuation, and the high timeliness and safety ranks are added benefits, as you can see on the page. Taking a look at some of the quantitative metrics, the stock has solid marks across the board, including safety 1, financial strength A++, as we have cited. Price stability is 95 out of 100, and price growth persistence is 70. The issue is favorably ranked, and the 18th month appreciation is 40% to the midpoint of RTPR. All told, we think that Medtronic is poised for strong results through calendar 2023, and the stock can form one of the building blocks of a successful portfolio. It is today's one stock to buy right now. I will now tackle your questions. Please notify that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few were submitted prior to this presentation, and now I'm going to hand it off to Sharif and Alan. Thank you very much. Guys?
Hey, Charlie, thank you. My name is Sharif Abdu, as Charlie just said. We had some good questions submitted before the webinar started. Let's see, we have one from John Harding, had the question of, on your quarterly stock screening report, how do you calculate relative PE and VL arithmetic mean? Specifically, what stocks are used in the denominators of both values? For example, all S&P 500, only peers in the same industry group, yada, yada. Okay, very good question, Mr. Harding. So the first thing I'll touch on is the relative PE value. Alan, if you want to show the top of the page that we are currently showing there, the value line report, if you want to scroll up a little bit. So you'll see the PE ratio for Medtronic right now on the latest report is a 16.5. And that's calculated. It's a pretty straightforward calculation. It's just the current price, which is $93.08, divided by our 12-month forward-looking earnings estimate. And that's on a rolling basis. That's always 12-month forward, and it's on a rolling basis. Right now, the current 12-month earnings from Medtronic would be through March of 2023, just to give you an example of how we do that. So we take the recent price, which is $93.08. We divide it by the 12-month rolling earnings through March of 2023, and that gives us the PE ratio at 16.5. Now, for the relative PE, we take the 16.5, which is the PE for Medtronic, and we calculate that by it's all stocks under value line review. So it's not just limited to the S&P 500 or peers in the same industry group. It's all stocks that are currently under value line review. And the entire value line universe, I believe it's, what was it, Charlie? About 5,400 or so stocks. And that gives us the relative PE, which is right now is 1.02 for Medtronic. So the stock is on a price to earnings basis, priced relatively in line with the market. That's the best way that I can describe it. If you look at the entire market PE as a 1, Medtronic is right now priced with a relative PE or a relative price to earnings ratio of 1.02. So it's priced, it's not a bargain, it's not trading at a premium, it's priced relatively in line with the market. Now, the second question that Mr. Harding had was the VL arithmetic mean. This is a more tricky question to answer. On the surface, it seems like a more tricky question, but it's actually pretty straightforward. So, Alan, if you show the page there, if we see where there's a little box, Alan, can you highlight the box there where it says the percent total return for 712 near the top of the page there? Yeah, you see by the price chart there where it says percent total return box. Thank you. So if you look in that area, you see that we have the certain percentages for this stock, which is Medtronic, and then we have the VL arithmetic index. So how that is calculated is it's an equally weighted price index, okay? So it's a very simple and very straightforward calculation. There is no algorithm used for this particular calculation. It's a simple, straightforward, weighted average price index of all stocks in the Value Line Investment Survey. And arithmetic in this case, it's referring to the averaging technique that we are using to calculate the average for this calculation, for this particular metric. So you have two different primary forms of, let's say, an index calculation. You have arithmetic mean, and then you have geometric mean. Geometric is a little bit more complicated. Arithmetic, more straightforward. It's just a simple weighted average index of all stocks that we cover in the Value Line Investment Survey. Let's see. So I hope that answers the question from Mr. Harding. Relative PE ratio is just, like I said, it's just the price to earnings ratio for this stock, which is Medtronic, divided by all stocks under Value Line coverage. Let's see if we can find another question here. We had a question submitted before the webinar started by Douglas Kiesling. He had a series of questions. I can't answer every question, but I'm going to focus on one that I think is very timely and very. It's a good question to answer right now, considering the current market. So, Mr. Kiesling had a question for retirement. What is your number one choice right now? So. That's a hornet's nest. I won't tell you what is my number one stock or number one choice right now, because there really is no way to answer that question. That's such a subjective question. I will say, just in general, for retirement, if you are looking for a stock that is an income-generating stock, but also since you're in retirement, I'm assuming he's Mr. Kiesling or someone in retirement is on a fixed income, and you want something that is an income-paying stock, so a stock that pays a dividend, you'll want to look at stocks with a safety rank of 1 or 2. You want to look at stocks with a financial strength rating of a B+ or above, preferably, A plus, A++. I would look, me personally, this is just my subjective opinion, me personally, I would look at Reits, okay, real estate investment trusts. And one of my favorite Reits as an investor is Public Storage. Okay, and the ticker symbol for Public Storage is PSA. It's not a glamorous company. They're not building high-rises. They're not building, Class A office buildings in New York City and San Francisco, yada, yada. It's not a glamorous company. They own self-storage facilities. I'm sure you all have heard the company or heard of the name of Public Storage. They own, like I said, self-storage facilities. It has a safety rank of, I believe, a 1. It has a financial strength rating of an A+. I believe it's an A+ or maybe an A++. It has a very good dividend yield. Again, not a rock star dividend yield. It's not, it's not going to blow your socks off, but it has a very solid dividend yield. The dividend itself, the payment, has grown steadily over time. The company's finances are very solid, very strong balance sheet. Those are the things that I would look at. So I would look at, again, just to summarize, I would look at stocks with a safety rank of 1 or better, or 2 or better, so 1 and 2. I would look at stocks with a financial strength rating of B+ or above, B++ or above, preferably A+, or A++. And I would look at stocks that have a very solid balance sheet. So you want to look at the percent of total capital, the debt to the. Alan, can you highlight that in the cap structure box? for our participants, if you can. So if you want to zoom down and look at the capital structure box and you look at that percentage there where it says 28% of capital, that is the percentage of debt relative to the entire balance sheet. That's the percentage of debt divided by debt plus shareholders' equity. And that just gives you a rough estimate of how much of the balance sheet, what is the leverage ratio of the company? How leveraged is the balance sheet? So that's another area you'd want to look at. So you want to look at companies with a very solid finances, a history of steady dividend increases over time. And I personally, my starting point is Reits. Utilities is also another good area to look at, although the utilities tend to be a little bit more stagnant in the results. So I usually look at Reits. Okay, let's take another question. I hope that answers the question for Mr. Kisling. So let's take a look at another question, and a question that was submitted today during our presentation. Jennifer McNicholas has the following question. I subscribe to Value Line 600. I know that the stars on the summary and index indicate a supplemental report. What do the stars mean on the ratings and report cover page? So for those of you not familiar, the ratings and report cover page is one section of the Value Line Investment Survey. And the stars, if you see a star, most companies will not have a star next to their name. It's an index with a listing of all the companies that we cover. If you see a single star, that means the stock is timely. Okay, that means it has a timeliness rank of 2. That means that the stock has an above average timeliness rank. Okay, that means that the stock, we expect it to outperform the broader market in the coming 6 to 12 months. All right, if you see 2 stars next to the name of the company, that means it has our highest timeliness rank. That means it's a timeliness rank of 1. Those are the stocks that we believe will be the best performers in the next 6 to 12 months. Okay, so that's what the stars mean when you're looking at the ratings and report cover page, which is one section of the Value Line Investment Survey. If you see a single star, it means it's timely, has a timeliness rank of 2. If you see 2 stars, that means the stock is timely, but it has the highest timeliness rank. That means it's ranked 1. Okay, I hope that answers the question for Ms. McNichols. And we had another question, Michael Parente, I hope I pronounced that correctly. Michael Parente had the question, how to figure free cash flow from your info. And I'm assuming that Mr. Parente is asking the question, how do we, looking at our full page report, how can he figure out what the free cash flow is? So in general, we don't focus as much on free cash flow, okay, because we generally focus more on cash flow. Just in general, we tend to focus on cash flow, not free cash flow. The reason is free cash flow tends to be a little bit more nebulous, meaning it tends to, what is considered free cash flow tends to fluctuate more. There is more variability in free cash flow and how it is calculated from company to company, whereas just cash flow tends to be a little bit more straightforward as a calculation. So Alan, if you want to highlight the cash flow line in our array, just to show our participants there. The cash flow, the numbers in the actual array, not in the chart. There we go. So if you look at there, that is cash flow per share. That's a pretty straightforward and simple calculation. So according to Value Line Standard, okay, Value Line Standard, cash flow is, as a general rule, it's net income plus non-cash expenses such as depreciation. Okay, that is Value Line Standard. We add back depreciation. And we use that because we want to make apples-to-apples comparisons. So one company may add back certain items, another company may not. So for Value Line purposes, to make apples-to-apples comparisons, we tend to just add back net income plus non-cash expenses such as primarily depreciation. Okay, I hope that answers the question for Mr. Parente. We had another question here. This was submitted before the webinar began. Anthony Russo asked the question, what is the difference between the timeliness rank and the technical rank? This is a very common question that we receive. This is actually one of the most asked questions that we generally tend to get. So the technical rank, Alan, if you want to scroll up to the top of the page there and maybe make the page a little bit larger so that people can see. Thank you. So if you look at the page for Medtronic, the timeliness rank is currently a 3. The technical rank is also a 3. So what does that mean? What is the difference between these two ranks? So the timeliness rank is it's sort of one of our, I don't know what you would say, it's one of our headline metrics. It's one of our proprietary metrics. It's one of the most important metrics that we use for stock selection. It's the probable relative market performance in the year ahead. That's the best way that I can say it. So we have a simple scale of 1 to 5, okay? 1 being highest, 3 being average, 5 being lowest. So in general, if you are an investor with a near-term focus, let's say your investment horizon is 6 to 12 months, you would want to select a stock that's a 1 or a 2. Okay, 2 means it will have it has above average prospects in the next 6 to 12 months, and a stock with a timeliness rank of 1 means that it has what we consider to be the highest prospects or the best prospects in the coming 6 to 12 months. Okay, and that's always relative to the broader market. Okay, so that's 6 to 12 months. Now we take a look at the technical rank. The technical rank is very similar to the timeliness rank. It is an estimated stock price performance relative to the overall market. But instead of looking at 6 to 12 months, we're looking at 3 to 6 months. So, okay? Same scale, 1 to 5. 1 being highest, 5 being lowest, 3 being average. So if you are an investor with a very near-term investment focus, okay, you're looking at 3 to 6 months, you would want to pay more attention to the technical rank, more so even than the timeliness rank. You want to pay attention to both, but you really want to pay attention to the technical rank because that is focused on the coming 3 to 6 months, okay? I hope that answered the question for Mr. Russo. We had another question from Michael Page. Mr. Page had the following question. Can you please touch on the difference or the correlation between the financial strength rating and the safety rank? So first, I'll touch on the safety rating. So if we look at the full page report from Medtronic, which we have up on the screen right now, we see that the safety rank is 1. So it is again a simple scale. It's a scale of 1 to 5, with 1 being highest, 5 being lowest. The safety rank is just a measurement of the relative potential risk associated with individual common stocks. Okay, it's used. We calculate the safety rank by using a host of different criteria. But the 2 main inputs in the safety rank calculation are price stability and financial strength. Okay, so financial strength actually goes into our calculation of safety. So if you are a very conservative investor, so for example, somebody like Mr. Kiesling who asked the first question that I answered, if you are somebody that is in retirement, if you are somebody that's living on a fixed income, or if just in general you are a very conservative investor, you would want to focus on stocks with a safety rank of 1 or 2, okay? Preferably 1 or 2. 3 is okay, but preferably 1 or 2, okay? If you're somebody that's maybe a little bit younger, you have a longer investment horizon, you're willing to take on a little bit more risk, typically stocks with a little bit higher risk, generally there's also a higher potential return. Then, the sky's the limit. You can go from 1 all the way through 5 as far as the safety rank is concerned. But generally speaking, you want to focus on stocks with a safety rank of 1, 2, or 3. And if you're very conservative, you want to focus on stocks with 1 or 2. Now let's take a look at financial strength. Alan, if you want to zoom down to the bottom of the page there. So we'll see that it says on the bottom right-hand corner of the page, okay. Thank you, Alan. And we see that we have a couple of different ratings there, a couple of different scores. And we see that for Medtronic, the financial strength rating is A++. Financial strength is a 9-point scale. It goes from A++ down to A+, to A, to B++, B+, and down from there. I believe B+ is considered average. Don't hold me to that. I believe B+ is considered average. So financial strength is also, it's looking at balance sheet leverage. It's looking at business risk. It's looking at the company's current profits and the direction of profits. Okay. It's looking at cash flow. It's looking at earned returns. So something like return on total capital, return on shareholders' equity. All those criteria go into how we calculate the financial strength. So generally speaking, again, this is just generally speaking, you want to look at stocks with a B+, that's average, and above. So B+, B++, A+, A++. If you are a very conservative investor, again, this is very similar to safety rank. If you are a very conservative investor, typically you want to focus on stocks that are an A+, or A++. Those are the companies that we feel have the strongest financial strength ratings, okay? And again, that's looking at the company's balance sheet leverage, business risk, profits, the direction that the profits are going, earned returns, etc., okay? And the two play off each other, safety rank and financial strength. Generally speaking, there's a correlation there. Generally speaking, there's a correlation there. Okay, let's see. Do we have any other questions? Alan, is anything jumping out at you? Any other questions?
Thank you, Sharif. Yeah, I see a couple questions that caught my eye. The first question relates to the operating margin, and I know there's different ways to calculate the operating margin. As you can see in our array, right underneath sales, highlighting it now, there's an operating margin. As you can see, it's 33.5% forecasted for 2022 for Medtronic. Our calculation excludes depreciation and amortization. There are other, sometimes the company itself will include D&A, depreciation, amortization. We exclude that. We basically do the operating margin on an EBITDA basis, which is earnings before interest, taxes, depreciation, and amortization. So that was a good question. I just wanted to point that out. Also, there was Sharif talked a lot about the timeliness rank and the technical rank. There's also the 18-month return potential, which is one of the metrics we used in Medtronic's screen, and the 3 to 5 year appreciation potential, which is right underneath there. Both of those, I think, are also important in evaluating a stock. There might be, like Sharif said, if someone was looking at the 3 to 6 month horizon, they might be looking more at the technical. If they're looking 6 to 12, they may be looking more at the timeliness. But there might be people, investors that are looking maybe for the next couple of years. What's a good, 18 to 24 months? What's a good investment over the intermediate term? And that's why we instituted the 18-month target price range several years ago because there are investors that look at the intermediate term, and of course we have the 2025 to 2027 projections as well for investors with a 3 to 5 year horizon. We've had that along with our timeless rank has been our mainstay for a number of years. So I just wanted to put that out there as well. And then there was one other question that caught my eye, and someone said, Sharif alluded to that, about the PE ratio for Medtronic being right around the market PE. And if you look at the historical PE of Medtronic, it has been, give or take, right around the market PE. It's pretty much average between 0.8 and 1.2, which is, for all intents and purposes, right around the market PE. You know, nothing's going to be 1.00 all the time, but it's pretty close. So it's pretty much been a market, you know, PE multiple. And someone has a question like, why would Amazon, with a timeless rank of 1 and a PE of 75, why would that have a timeless rank of 1? And, you know, meantime, Medtronic has a timeless rank of 3. And it's like, you know, there's different industries and different stocks command different PE ratios. You know, like Apple's going to have a much different PE ratio than, say, a utility company. You know, it's based, I mean, I do like to look at the market PE to see where it stands, but I also like looking at the historical PE for the company, because if a company normally trades at 2 times the market PE and is now trading at 1.5 times, but the earnings picture still looks pretty good, it could possibly be a good value. I mean, you have to look at a lot of other things, but that definitely could be a good valuation, parameter. So, so we look at a lot of different things, especially when it comes to the timeliness rank. But, regarding the PE ratio, I think it's good to compare it to the broader market, but it's also good to compare it to its historical averages and also the industry in which it operates. Some of the tech companies, command a higher PE ratio than maybe like a railroad company or what have you. So I just wanted to, to answer those few questions. And if anyone has any further questions, feel free to call 1-800-VALUE-LINE or go on the website. That's www.valueline.com.